Should we be worried, John, about some of the impact of the COVID variants on developing economies, especially in places like Asia?
You know, Dominic, I very much think so. In fact, we can't help but think that's one of the reasons why we have seen some of the international markets suffer in performance recently. The question is, how are they going to come out of this? And so between the questions related to inflation and the questions related to the variants, the market does have underlying concern and has a wall of worry that it will need to climb during this period.
All right. So in many measures of the emerging market, we're showing one of the ETFs that tracks it right now, the ticker EEM. That's the iShares Emerging Market ETF there. It's been pretty much kind of range bound for a while. Is the next leg lower if this COVID variant, the Delta variant, starts to really take hold? We're already seeing some underperformance in key parts of those markets.
Dominic, I think it would most certainly be a potential for a next leg lower if that variant does take hold and it begins to cause shutdowns. It really depends. You know, the sense of with the variant at this point is ultimately what it would do if it's left to run. It's open-ended as to what the damage would be. So we'll just have to see. Thus far, what we could expect is we'll have to monitor the situation. But we do not think it is at a critical point, at least at this point, especially considering the advancements in the vaccines that have been made over the course of the last year.
So John, if that is the case, I mean, markets are still, they've seen some weakness, you can argue as of late, but they're still within a stone's throw away from record highs. Is the market in a position where it's vulnerable to possible downside, given this kind of a uncertainty, I guess, around the Delta variant?
Yeah, Dominic, we always think that, you know, the market is always vulnerable to downside if traders, nervous investors, and skeptics can find a reason for a catalyst that can enable them to take some profits at these high levels without FOMO. That said, earnings season is looking good stateside. And as we move forward, so long as the variant can be controlled or stemmed, you know, we're headed out of the woods.
So if we're heading out of the woods, that to me has signaled, at least for the pandemic recovery trade, places like travel and leisure, places like industrials, certain other deep value kind of cyclical plays, commodities, that sort of thing. Does that mean that that's where you should go, given that we've seen those places underperform in the last couple of months?
Yeah, Dom, we have to say, when we look at this, we want a broader exposure. We want to own consumer discretionary, we want to own technology, and then we want to barbell it with industrials and as well as industrials, as well as materials and financials. And the reason for that is we think this is a market that maintains a position day to day, week to week, where it can rotate and rebalance very much between reopening trade, growth versus value. It's broad diversification is the best way. And from what we're seeing here thus far is we are seeing investors, both institutional as well as retail, as well as private client, using professional advisory, really opting more and more for diversification. And we think that's a good thing.
All right. Before we let you go, just about 10 seconds left here. Interest rates, are they a worry right now?
Interest rates, something to be monitored, but we think they will rise gradually because we think there are secular offsets to inflation.
Shepard Smith here. Thanks for watching CNBC on YouTube.